Hi, I'm Ingrid Zip and welcome back to my YouTube channel. On my YouTube channel, we talk about technology, entrepreneurship, and personal finance. So if those are topics that interest you, definitely subscribe. With that being said, let's dive into the topic for today, which is taxes and investing and how you can save the most money on your taxes as an investor. There are two reasons why you want to save money on your taxes as an investor. The first is that obviously any money that you pay in taxes is money that you no longer have. And then the other reason is that if you are able to keep more money, your account will actually grow more in compound interest over time. So as an investor, paying more taxes means losing in two ways. The higher your tax bracket, obviously, the more important these lessons are going to be, and the more you can lose in taxes if you don't learn about this and really commit yourself to making good decisions. So there are two main things you want to consider for tax efficient investing. The first is making investments that are tax efficient themselves, and the second is having the right types of accounts hold your investments. First, we're going to talk about making investments that are tax efficient, and to do that we have to understand capital gains. A capital gain is an increase in the value of an asset, such as a stock. Capital gains must be claimed as income on income taxes. A capital gain can be considered short-term, which is an asset you've held for less than a year, or long-term, which is an asset that you've held for more than a year. And one thing to note is that long-term capital gains are actually taxed at a lower percentage than short-term capital gains are. Short-term capital gains, again that's capital gains that you've held for less than 1 year, are taxed at normal income tax bracket rates. Long-term capital gains, which are assets that you've held for more than 1 year, are taxed at a flat rate of 15% for most people and 20% for people in a higher tax bracket. So while the highest long-term capital gains tax bracket is 20%, most people qualify for a 15% tax rate on long-term capital gains. Luckily, capital losses are also accounted for on income taxes. So if you bought an asset that accumulated $3,000 in value, but you also bought another asset that lost $1,000 in value, then you would be liable to pay taxes on $2,000 of capital gain value because your capital losses are also accounted for in your capital gains income responsibilities in terms of taxes. Taxes on capital gains are also separate from taxes on dividends that are paid out by a company. Dividends actually have separate tax laws that apply to them. So now that we've gone over investments and which ones are more tax efficient, the long-term capital gains are more tax-efficient investments, let's go over the types of accounts that you can have. So there are two main types of accounts. There are taxable accounts and tax advantage accounts. A taxable account is sort of like your typical brokerage account. So the type of account that you would open on an app like Robinhood or Webull or even Fidelity is a brokerage account. These accounts don't really have any tax advantages, but they do have more flexibility than your typical tax-advantaged accounts such as an IRA or a 401k. Unlike an IRA or 401k, with a brokerage account, you can withdraw your money at any time for any reason without any special penalties. If you hold investments for more than 1 year in a typical brokerage account, you'll pay either 0%, 15%, or 20% tax on your capital gains, depending upon your tax bracket. If you hold a stock in a brokerage account for less than 1 year, then it'll count as a short-term capital gain and it'll be taxed according to your tax bracket. Now let's go over some tax advantage accounts, namely the IRA and the 401k. IRAs and 401ks are examples of tax advantage accounts. Tax advantage accounts are usually either tax deferred or tax exempt. A tax deferred account, such as an IRA or 401k, usually give you an upfront break on your taxes. So you can deduct the contribution that you make to the IRA or the 401k upfront and not pay taxes on that contribution, but then you will pay taxes later in retirement when you take money out of the IRA or the 401k. The IRA and the 401k actually have contribution limits. So for 2020 and 2021, your contribution to an IRA can reach $6,000 or $7,000 if you're 50 or older because of the catch-up contribution. For a 401k, you can contribute up to $19,500 or $26,000 if you're age 50 or older in both 2020 and 2021. The combined employee-employer contribution can't exceed $57,000 with a catch-up contribution of $63,500 for 2020, or $58,000, and if you're doing the catch-up contribution, then it'll be $64,500 for 2021. So then you have your Roth IRA and your Roth 401k, and these are considered tax-exempt accounts. So you actually contribute to these accounts with post-tax dollars. So you pay taxes on your income, and then you contribute to your Roth IRA or your Roth 401k, and these investments grow tax-free for the rest of your life. And then if you take your money out of those accounts at the right time, that's also a tax-free benefit. You can withdraw from these accounts without paying taxes because you already pay taxes on that money that you contributed to them. So now let's go over tax-efficient investments. Most investors know that if you sell a stock in the short term, you're going to owe capital gains on that investment. Or if you get dividends from a company, you may owe taxes on those dividends. But by nature, some investments are more tax efficient than others. For example, if you invest into ETFs or exchange-traded funds or index funds, probably those are very tax efficient investments because you're holding the same number of companies or the same amount of companies for a long period of time, and those companies aren't being bought and sold as stocks behind the scenes. Whereas if you invest into a mutual fund, the mutual fund managers might be buying and selling stocks behind the scenes, which could result in more taxes on capital gains for you. So in summary, let's give a quick rundown of what we just went over. If you have your money in a brokerage account, which is a taxable account, then try to hold your stocks for at least a year. That way you're incurring long-term capital gains tax on those stocks instead of short-term capital gains tax. Consider investing into tax-efficient funds such as ETFs, index funds, or funds with low turnover rate. If you're going to be holding inefficient or tax inefficient investments, maybe hold them in a tax advantaged account. So if you're holding individual stocks for less than a year, maybe hold them in a tax advantaged account such as an IRA or a 401k. If you're going to be holding actively managed funds that may have substantial short-term capital gains, then you could hold them in your IRA or your 401k. Additionally, real estate investments may also be better to hold in tax advantaged accounts. With anything in life, there are trade-offs when it comes to taxes and investing. If you want to hold your money in a brokerage account because of liquidity, then just be careful about your short-term capital gains and be aware so that you can make those decisions and have those trade-offs. If you want to hold your money in IRA or 401k, you know you're not going to touch that money for many, many years, then that's also a trade-off that you don't have that liquidity, but you might have more tax advantages in the long run. So I hope you learned something in this video. I hope it was educational for your investing and taxes purposes. Definitely subscribe to my channel if you want to see more videos like this one. Drop me a like below if you liked it. And quick plug here, if you want to learn to code, I have an online course. It's $47, really good price. It teaches JavaScript, HTML, and CSS. You build a simple portfolio website, and it's honestly the easiest to follow. Like, it's everything that I wish I would have had when I started coding. So yeah, I hope you guys enjoyed this video, and I'll see you in the next one. Peace.